how do we trade currencies? First of all, what is currency trading? Let us see that. Actually, if somebody wants to trade at a very, very low risk with very, very low capital and still make good money, I'll recommend him currency trading. Okay, better than even going for stock futures, stock options. Maybe second only to Nifty, or comparable to Nifty even sometimes. So buying and selling of international currency, futures and options. You cannot directly go and buy dollars, but you can buy dollar futures. Okay. So either it is against Indian rupee or it can be against two different foreign currencies. Suppose your view is euro is going to fall against US dollar. So USD, euro, dollar euro contracts you can buy. Okay. Or dollar yen, Japanese yen. Likewise, you can buy or sell pound, British pound. Now, actually speaking, what is the expiry? Expiry is every Friday at 12:30 p.m. And USD INR is, that is dollar, American dollar to Indian rupee, is weekly contracts, very good liquidity, no problem of liquidity at all. Okay. There is another expiry which is 2 days before last trading day of the month or end of the month contract. Now here comes the funny part. Every Friday's liquidity has very good volumes. Okay, every Friday contracts. But last Friday contract can sometimes be problematic, like it was just day before yesterday. Day before yesterday was a Friday, which was in October. All right. So 28th of October, contract was available. But the second type of contract is expiring 2 days, trading days before last day, trading day of the month. Now, last trading day of the month is Monday, tomorrow. 2 days before was Thursday. Right? 2 working days, 2 trading days. So 27th October contract was also there. Then what we get is when 2 different expiries are there, usually the contract which expires 2 days before, that is 27th October, has fantastic liquidity, but 28th October liquidity is not there. Actually, that's a Friday contract. And every Friday contract is liquidity, but not on last Friday if it is different from the monthly 2 days before the expiry month contract. All right. So there were some contracts expiring on 27th October, some on 28th October. The liquidity in 27th October contract was 20 times higher than 28th October contract. 20 times higher liquidity. This is observed only at the last contract of the month. Other way around, Friday contracts are fairly liquid every Friday, and I trade them. Okay. Margins required are low, risk you can easily control, you can hedge it easily, low margins are required for hedging. So actually very good. Easily you can trade them. Okay. So as I said, it is observed that last week of the month, Friday contracts have significantly lower liquidity than one expiring 2 days before the last trading day. So we at the end of the month, whichever contract you are trading, you have to see that which one exactly I want to trade and how much is the liquidity. Other Fridays, no problems. Okay. So just check the liquidity. Now, which currency futures can we trade? Euro INR, Euro rupee you can trade. Euro USD you can trade. So if your view is Euro is going to fall against dollar, you are going to short this contract. If your view is Euro is going to rise against the dollar, you have to buy this contract. GBP INR, Great British Pound against Rupee. INR is Indian Rupee. GBP is Great Britain Pound. GBP USD, Pound to American dollar, US dollar. JPY INR, Japanese Pound, Japanese Yen. Okay, Japanese Yen to Rupee. Then Omnibor. Now, actually, this is overnight interest rates, international interest rates. But as of now, liquidity is so low that at times I have seen not a single lot traded in the entire day. Omnibor, I personally don't even track it or follow it, nothing. USD INR, most popular, most common. USD JPY, dollar rupee, dollar yen again. So all these contracts can be traded. But naturally, those which are against the rupee, they are the most liquid. Now, Euro USD, directly you will find in a day 600, 700 lots are traded. So instead of going for that, I would say if you go for Euro INR and USD INR, you can create the pairs which are called synthetics. You'll see what are synthetics a little later. So out of this, which with fair liquidity, more than 10,000 contracts, 10,000 lots traded per day. They are Euro Rupee, Yen Rupee, Pound Rupee, and Dollar Rupee. These four are maximum liquidity contracts. Options. Options are available in all, but only dollar has liquidity. Most of the other options, they are existing, nobody trades in. Okay, fine, slowly, steadily, as and when the liquidity increases, then we can start trading them. But at present, there is no point in getting stuck in those lots. So USD INR, we will limit to USD INR for now. What is the advantage of trading currency? See, one thing is there. Suppose if, let us, as an example, let us take dollar rupee. If the rupee starts appreciating against the dollar, dollar becomes cheaper. What will happen? Things that India imports and things that India exports. What you are importing will become cheap for you, but what you are exporting will be expensive in the foreign countries. Okay. Actually, suppose, let us take for convenience, dollar is at 80 rupees. So one Indian article which is exported from India is costing 80 rupees in, or $1 in US. So American buys this Indian good for $1. Now dollar rupee becomes 10%, dollar becomes cheaper, it becomes 72. What will happen? Instead of $1, this person will have to pay $1.1 to buy the same thing now. Because in India, they are expecting to get 80 rupees, but dollar is only 72. Actually, your exports get a beating if your currency appreciates. What happens if rupee falls against the dollar? Naturally, now your things will be cheaper in other countries, but your imports will become expensive. Okay, so whatever you sold for $1, now that person will be happy because he has to pay only 90 cents for it. Instead of 80, it becomes 88. He has to pay less. But whatever you are importing, like crude oil, you'll have to pay 10% more. Naturally, because of that, RBI doesn't allow any of these currencies to go up or down significantly by large magnitude. So if dollar starts increasing, what RBI does, it starts selling dollars which it is having. Naturally, the supply increases, price comes down. If dollar starts falling, what RBI will do? It will start buying dollars using the rupees it has. Again, dollar will come up. It will not allow a huge oscillation, huge change in price, unless and until it really becomes necessary. Like now. Now, why has dollar come up? Because RBI kept on selling dollars in order to keep prices low. But then they had to practically say when you're selling dollars, your foreign exchange you are losing. So the losses in foreign exchange were too big. RBI said, okay, now here we are not going to sell any more dollars. Okay, so that is the difference. RBI is your friend when you're trading dollars properly, dollar or any currency. Investment is relatively low, especially with options. The lot size, say for example, for US dollar or even euro, is $1,000. $1,000 means how much? If you consider dollar is 80, 82, 83, so 83,000 rupees is one lot. Margins required are so less. If I want to buy at the money call, it may be costing me something like 15 paisa, 20 paisa. So 15 paisa multiplied by 1,000 is 150 rupees. So I can buy one lot of call option at 150 rupees. A risk which anybody can easily take. Okay. And keep it for selling, say 20 paisa, suppose 25 paisa. And easily you can make money. You can buy at the time 10 lot, 100 lots. If done properly, the risk is fairly low. Okay. Easy to hedge. You can buy one lot and sell two lots at higher price. Okay. For selling also, about 1,500 to 2,000 rupees margin is required per lot. So not a huge investment. You get approximately 40 times leveraging. Means only your lot value is 83,000. So 83 divided by 20. Only that much margin is required for selling one. Right. Sorry, divided by 40, not 20, divided by 40. So only around 2,000 rupees. Synthetic trades are possible. Now, suppose my view is euro is going to fall against dollar. But euro dollar doesn't have liquidity. Euro rupee has liquidity. What I can do? Sell euro rupee, buy dollar rupee. Sell EUR INR, buy USD INR. So my rupee gets leveled out and my lot becomes equivalent to euro dollar. That is called a synthetic euro dollar futures. So Europe is having financial problems. Europe is going to fall. Dollar is likely to rise. I want to create a euro dollar futures short position. How can I do it? Either directly I short euro dollar, but which has low liquidity, or sell euro rupee, buy dollar rupee. Synthetic. So synthetics are possible. Yuan, say Japanese yen or pound. Just recently I did this synthetic in pound dollar. When pound was falling, I shorted pound, I bought dollar futures. Okay. So as they came closer, square of both the things also together. Just synthetics. And as RBI does not typically permit huge move in currencies, risk is limited. Okay. You can sell at the, of course, you have to look at the conditions, market conditions, but if you keep on selling call and put at the money, all right, most of the times the trades become profitable. So every Friday I sell, call, sell, put for next week, and next Wednesday, Thursday, square it off. Commonly done. Only when there's big move likely, or you hedge it. That's the best way. So these type of trades are possible, limited risk, low investment, and really, really good returns. Okay. So more importantly, your view should be clear about what you want to trade, and then you can make money. What are the risks in currency trading? See, leveraging is huge. As I said, 1:40. So if dollar goes up by 1 rupee, your loss is going to be big. Understood? For say 1,000 rupees per lot. If you take 100 lots, then it will be 1 lakh lots loss. Of course, if you are in futures, short in futures, or you sold calls, then it can happen. So because leveraging is very high. And lower margins tempt you to take too larger position. Here you have to be careful how much loss can I afford? Or, it's actually speaking it, if you have capacity, this trading cannot go in a loss. Of course, if you done properly, but it cannot go in loss, you can recover all the losses. But to recover that, you should have money. Huh? If you want to continue the position for the next week, then you need money for that. Okay. So you have to see your capacity and then take the trades. So I hope you already opened the account over there. Any questions in currency trading? Very simple, very easy to do. Even a novice can easily trade currencies without any problem. Please explain about synthetic trade. I'll explain that. Okay, here is the link again. Those who have not clicked it, I'll explain the synthetic trade. Just give me a minute. Any questions? Yeah.
Hello, है प्याज कितने लो 4 किलो
Please mute yourself. You don't want to ask.
हाँ हाँ अरे
You don't understand or what? How to check liquidity? Just see the daily volume. Just see the daily volume, how much is traded. What you can do is you can go to just a moment. You can go to nseindia.com. So here is nseindia.com. What you do is just search over here currency options chain. Okay. And you will get currency options chain. And as it opens, of course, right now it's closed. Is at 20th October. Forget that. Let us go for 4th November expiry. This is the next one. 20th October was already 2 days back. And how much is the liquidity? You will find it here. How many lots are traded? Okay, how many are open position? You can see your open interest 2,01,000. So 2 lakh positions are open for 8250 calls and 8250 puts on this side, opposite side. Okay, 1,40,000 open position. So that is a good liquidity. Anything more than 1 lakh is a good liquidity. And you will find out of the money, in the money also having fairly good liquidity. The contracts for dollar are 25 paisa. I'm sorry, 0.025 paisa is the future stick size and 25 paisa is the option size. Options. So strike prices are 25 paisa apart and futures 0.00, say quarter paisa, 0.25 paisa. That is a tick size. Okay. That is how you can check liquidity. Synthetic trades, I'll explain at the end. Any other questions to anyone? Okay. All right. So now, let us see about the synthetic trade. Okay. So now let us say, just enlarge this. So Euro ISD, sorry, Euro USD. Euro USD, if I am buying, I'll just take an example. So I am buying Euro to dollar, and instead of that, I'm buying, I'm a buyer. Buy Euro USD against buy Euro INR and sell USD INR. All right. So this is the strategy I'm going to do. Suppose. Now, currently, if we see the prices, suppose Euro INR, Euro USD, this is at 1.1. right? Euro INR. Let us say this is at 88. And USD INR, let us say it is at 8. Now, suppose Euro goes up by 1 rupee. What will happen? I'll gain 1 rupee here because I have bought Euro INR. All right. And let us keep it here. $1.1. Dollar goes up by, let us say, dollar becomes 82. All right. So you are going to get this one. What you will find is, if this happens, your Euro USD ratio will also become same. Because this rupee and rupee cancels out. Okay. What is your net effect? Your net effect becomes when you do these two positions. So instead of buying this, if I buy this and I sell this, the net effect remains the same. All right. Because when I say it becomes something like Euro upon INR because I'm buying it. Correct? Multiplied by INR upon USD because I'm selling it. So this a simple mathematics. Just a moment. Just a moment. So see what this equation becomes. This becomes Euro divided by rupee. Okay. Euro divided by rupee multiplied by rupee divided by USD. Why? Because I'm buying Euro futures and I'm selling dollar futures. Naturally, what will happen? The common factor rupee will get cancelled out. And this will become essentially equal to Euro upon USD. Simple maths. So instead of directly buying Euro to USD, if I buy Euro to INR and short USD INR, the net effect becomes the same. That is called synthetic Euro USD. Why I'm doing this? Because direct Euro USD has very low liquidity. But Euro INR has good liquidity, INR USD has good liquidity. Okay, so I can create synthetic longs like this, and that also is advantageous. That is called synthetics. Understood this? Any other question? Any other doubt to anybody? Any questions related to this, unrelated to this? Any other questions about the market? If you don't have questions, we'll stop over here.
Madhav Desai here.
Yeah.
Sir, while checking the currency chart, which time frame we have to follow usually?
See, it depends on what type of trader you are. It is not something like, good for everyone. It's not like that. What type of trades do you take?
Suppose I am an intraday trader. If I am an intraday trader,
If you are an intraday trader, you can, again, even though I say intraday, see, somebody will say, I am happy with 5-minute chart. Somebody will say, I am happy with 15-minute chart. There's nothing like, perfect time frame. Nothing like that. Simple thing. Is grass a food or not?
Yes, sir.
Okay. Is raw meat a food or not?
Yes, for someone.
Exactly right. For someone. If I give you grass or raw meat, will you be able to eat either of them?
Not at all.
Understood? So for a tiger, raw meat is a food, grass is not. For a cow, it's the other way around. And for a human, neither of these are actually food. Neither grass nor raw meat. So it depends on what are you doing, what time frames you prefer. There's nothing like a perfect time. Somebody will say 5 minutes gives me great results. Somebody says, oh, 5 minutes, I don't touch it. I require at least 1 hour chart. Fine, both may be correct. What you have to do is you have to develop your trading system and then stick to it. The developing is what is to be learned, and sticking is to be learned more. In fact, I'm thinking of keeping a separate complete course on how to control emotions when you are trading. A lot of psychology is involved when you are trading.
Yeah, that is necessary, sir. That is the most necessary.
It's not easy. It is a process, and you have to really work on it. It doesn't happen in 1 day, or even 1 year, or even for a lifetime for some people. Okay. How you trade is important. How you control your emotions, that is important. Anyway, so somebody who is very comfortable with end of the day charts will not be comfortable with 5-minute chart. And somebody who is working with 5-minute chart, he will say 15 minutes, who is going to wait that long? Okay. So it cannot be generalized like that. Everybody has its own preferences and where is comfortable. Any other doubt? I want to hedge short straddle in USD INR. How far OTM should be bought ideally? Again, Mr. Bokle, this is subjective depending on situation to situation. Number one, what is the trend in USD INR? Is it uptrend? Is it downtrend? Is it flat trend? If it is strongly up or down, short straddle is not the strategy to be done. First thing. If it is flat, then you can check how much risk you can take and how big position you are taking. Larger the position, closer should be the hedge. See, suppose I have capacity, easily I can buy, let us say 100, I can sell 100 lot call, 100 lot puts. I can easily do it. But I want to keep a protection against it. I am very sure USD INR is very less likely to go 50 paisa plus or minus range. I may keep my hedge 1 rupee up and 1 rupee down, or 75 paisa up, 75 paisa down. Okay, because 75 paisa, if I keep still, my risk reward remains somewhere like 1:2. But my capacity is 100 and I am taking 200 lots. Then my hedges will have to be closer. Then I cannot take that risk. Maybe I'll be wiped out if I take that bigger position. So your risk-taking capacity and your actual open position, you have to take both into consideration. Now, suppose my capacity is 100 lots, but I am taking only, say, 10 lots or 20 lots. I may not hedge it. I'll say, okay, fine, let it go anywhere. I can always recover it later on. Okay? So there's nothing ideal. Same thing what I explained Mr. Desai earlier. It is individual. Somebody will say, sir, 1 rupee away, I'll get a sleepless night. Somebody else will say, so why to buy a hedge? I'll just sell, call, put and sit quiet. Nothing, no problem. Let it go anywhere. Individual. Your risk-taking capacity, just see to it that you are not. If when I take a trade, first thing what I have to keep in mind, how much I'm ready to lose in this. Even if this much is lost, I don't care. So before taking any trade, you have to decide that. And then only you can think of hedging, non-hedging, whatever. Okay. Any other doubts? So how far it can be, it should be there. Ideally, I'll say something like 50 paisa to 75 paisa away for majority of people. If you are selling at the money, call and put. You said you are selling short straddle, right? You're short straddle. So 50 paisa to 75 paisa away on both the sides. 50 paisa, your profits will decrease, but your risk will also decrease. 75 paisa, profits will increase in case it doesn't move. In case it moves, risk will also increase. More than 75 paisa hedge usually has no meaning, but for lowering the margins, you can do it so. 1 rupee away. Okay. Right now, if you see price of USD INR, say for example, 82.50 call is 28 paisa and 82.50 put is also around the 29 paisa. So together it's giving you 57 paisa. Okay. So 75 paisa lower put is going to cost me 1 paisa. And 75 paisa higher call, that is also going, no, that is costing how much? Sorry, I checked the wrong price. 4 paisa and 6 paisa. These are the prices right now, if you see. So if I sell 82.50 call, 82.50 put, I'm going to get 57 paisa. And 75 paisa up higher call and lower put, that's going to cost me 10 paisa. If I do that, what I'll have, 47 paisa I'll have in my hand. Because 57 I got, 10 I paid back. Out of 75 paisa, 47 is my maximum profit. And 28 paisa, 47 to 75. That is my maximum loss. So fine, if I'm ready to take 28 paisa loss, I can do this strategy. That is, sell 82.50 call, sell 82.50 put. Then as a hedge, buy 83.25 call, which is at 6 paisa, and buy 81.75 put, which is at 4 paisa. If I don't want to take 28 paisa risk, then I may buy 83 call and 82 put. 83 call is costing me 11 paisa and 82 put is costing me 9 paisa. So 20 paisa I pay back out of 57 received. So I get 37 in hand. 37 to 50. 13 paisa is my risk. 37 is my reward. My risk reward ratio has improved. But in case it moves, right? It remains in the middle, my profit has decreased. Earlier I would have got 47 paisa. Now I get only 37 paisa. So based on that, you have to decide which is the best for you. Any other doubts? Okay, so if there are no other doubts, we'll stop over here. How are the currency contracts settled? Cash. Currency contracts. Please mute yourself. Gaurav, mute yourself. Okay, so they are cash settled. But I'll tell you, if your contract is expiring in the money, don't allow it to expire. You close it, you sell it off or buy it off. Because in the money contracts, especially, settlement charges are much more than brokerages that you pay. Okay, or 20 rupees per order, and your position will be squared off. Settlement costs are a few hundred rupees. So why bother? Because that is per lot. Okay, so they are cash settled, but not advised to allow them to expire. You close it. That is better. If it is out of the money, it will expire worthless. There are no charges on that. If it is in the money, then only you are going to make money. But then instead of allowing it to settle close, you close. You sell it. Or you buy it back if you are shorted. Any other doubt? So, hedging. No, hedging is, suppose you have sold a put. You buy another put out of the money. So in case dollar falls, that put will save you. That is called hedge. Hedge means what? Fence. Same way, if you have sold a call at the money, you buy another call which is out of the money. So if dollar shoots, that will protect. So what I discussed was selling 8250 call and selling 8250 put. If both these are to be sold, I may buy 82 put and I may buy 83 call as a protection, FT, insurance. In case there is a sudden movement in USD INR, suppose dollar goes to 81. If I have just sold it, I will be losing 1 rupee 50 paise. If I have bought another put, my net loss will be limited. Same way, if dollar shoots up to 85, my sold call can go in losses. But if there is another call which is bought, it will limit my losses. That is called a hedge. What is the margin required for hedging? A margin required for hedging is, actually speaking, sell. Suppose you sell at the money call put and buy out of the money call put, depending on how far away you buy, something like 1500 rupees for the full 4 positions. To sell and to buy, 1500 to 2000, depending on how close or how far are your hedges. Okay, so one call put buy sell and one call put sell and one call put buy. First you should buy, then you should sell. Then the margins are required less than 2000 rupees per full 4 positions. Maximum risk reward you have to calculate. Depends what you have sold and what you have bought. How can I generalize like that? And for what premium? Okay. Just give me a second. I'll just show you that. Just a moment. This is an Excel sheet which I have prepared for my convenience. I'll just share it with you. Here's the screen. Okay. Now, let us say, for example, I'm selling 8250 call for say 0.28, and I'm selling 8250 put for 0.29. Okay. I'll keep the prices from 81, the difference of 0.2. So as you can see, my maximum profit is 0.57 if expiry comes at 8250. I hope it's visible to you. Okay. Okay. Just a moment. Line. Now it's visible. So 57 is maximum profit. But if it goes to 81, my loss will be 93 paisa. If it goes to 84, it goes to 1. So actually both the sides the loss will go on increasing continuously. Instead, suppose if I'm buying this 82 put, which is at 4 paisa, and I'm buying this 83 call, 82 put should be here, 0.04, and 83 call, I'm buying for 0.06. Now what happens? Now my maximum risk, lowest line you can see remains 3 paisa here. All right. And maximum reward is 847 paisa. So it becomes convenient, right? Prices are not this. I think I took the wrong values. I took of 75 paisa. What are these? 9 and 11. Answer. So this is 11 paisa and this is 9 paisa. That is why. So 13 paisa is my maximum risk and 37 paisa is my maximum reward. All right. As you can see, the lowest row. So my risk is 13. My reward is 37. The risk reward ratio is almost very close to 1:3. Correct? So I can take this trade. So sell 8250 call, sell 8250 put, and buy 83 call and 82 put. I can take this trade easily. Right? That is how we decide what is the risk reward ratio, and they take a trade accordingly. Any other question to anyone? Else we'll stop over here. It's already past 11:30. All right. If you have any questions, you can put it on Telegram channel, no problem. And this recording, I think by tomorrow it will be loaded on YouTube, and I'll be sharing the link with you, so you can have a look at that. I may split it into two parts: one commodities and one currency. Okay, I'll split it into two, and then I'll share it with you. You can have a look again if you want. You can watch it. So thank you very much.
Thank you, sir. Thank you.
Those who want practical experience, a live trading video, no, you just open the account. I'll just be helping. Open the account and send me the details, and you will get all practical guidance. What trades I'm taking and everything. Okay. So thank you very much. See you soon.